So we have more movers for you. If I said a company beat on the earnings, beat on the revenue, and had strong guidance, how do you like that? Well, Diane King Hall, host of Morning Movers, has that name for us right now. And Texas Instruments, a big winner.
It's got a win on the board, and it certainly needed this given the performance year to date of how shares have done. Look, it was, though, a low bar, but they cleared the bar for both revenue and adjusted EPS. Adjusted EPS coming in at $1.28 a share. That beats street expectations. Street was looking for $1.06. Revenue topped $4 billion. That beat forecast. Street was looking for more along the lines of $3.9 billion. They also gave upbeat guidance. So for Q2, they're forecasting revenue between $4.17 billion and a little more than $4.5 billion. So that is above what consensus views are for guidance. You had some questions about if customers were pulling forward orders, say in anticipation of tariffs. Top brass over there at Texas Instruments say they can't confirm the why. They say, quote, customers don't tell us why they ordered the way they do. They simply have the orders. In terms of market reaction, you are seeing shares of Texas Instruments move higher off the back of this news, rallying about 6% at the moment. Again, certainly need this gain given shares are down double digits year to date. There's still some uncertainty as it relates to the macro picture and tariffs. They talked about that on the earnings call. As we know, President Trump has exempted for now semiconductor chips from these additional levies. So that is helpful. But of course, on the flip side, you have that tug of war, that tension between the U.S. and China. And Beijing has high tariffs on U.S. made chips. Now, one of the things that Intel has done previously is they have a factory in China. So that allows them to do some work there. Essentially, it's this like China for China policy. But at the same time, it puts them up against domestic producers over there, and domestic producers often have also the benefit of subsidies from the Chinese government there. So they do have some tough competition, but right now as it stands, big picture, they did well on the trailing quarter, and their guidance looks really good, and the street is rewarding them with a big thumbs up today, Nicole.
Yeah, and it's nice that they have a arrow because the whole 1 year is not so great. I mean, 1 year is down, but the high last November was 220. So right now in 6 months, it's down 20%. 3 months down 20%. So shareholders were welcoming this.
Yeah,
right?
They are certainly welcoming this. And I will say this, even though this was good news for Texas Instruments, and they cleared the bar with regard to profit and revenue, you are seeing analysts adjust price targets to the downside. They are generally maintaining their status on their views. For instance, Jefferies has a hold rating. They're maintaining that hold rating, but they're reducing their price target on Texas Instruments to $155 a share. For KeyBank, they're actually overweight, so they're more constructive on Texas Instrument, but they are reducing their price target. Their new price target is $215 a share. Deutsche Bank has a hold rating as well, similar to Jefferies. Their new price target is $170 a share, which is down from $190. So there's still some upside from here, but certainly less than where they saw it previously.
Yeah, and we'll get to Chipotle now. Just quickly, folks, Intel says while we're on tech, Intel says it's cutting some staff ahead of the earnings. So we'll watch and follow Intel today. Chipotle, so this one is up 2.7% after the earnings.
Yeah, well, this is interesting to see because it had been under some pressure previously. So we may see this one bounce around today. It is up 2.5% off the back of their numbers. Mixed bag here. They did report adjusted EPS of 29 cents a share. That was a beat. Revenue came in at $2.9 billion. That was slightly lower than expectations. In terms of same-store sales, that actually declined. Same-store sales fell 0.4%. That is the first drop since 2020. So we're going back to pandemic days, well below the growth that was anticipated. The street was expecting same-store sales to increase more than 1.5%. They cited consumers pulling back. They talked about the economic uncertainty as one of the reasons that consumers are pulling back on their restaurant visits. They have this traffic slowdown that they saw, honestly, from the winter into the spring. And so this is coming up despite seasonal trends. They did blame weather to some degree, adverse weather, late Easter this year, for dampening what they call, quote, burrito season demand. Spring is usually their busiest time. But again, we really had essentially a later spring this year. They cut their guidance, the top end of their forecast for same-store sales growth to low single digits. That's down from low to mid single digits. They're not expecting traffic to grow until the second half of the year. Again, they're worried about the consumer and also worried about the tariff impact, tariffs on aluminum, and then of course avocados from Mexico.
And so, yeah, and the big thing is whether or not people are going to not spend because they're nervous and they're trying to save money, and it's every different sector. We talked about airlines without guidance. We're talking about Chipotle, maybe they won't come out. And if they do, maybe they just spend less while they're there. How about Comcast?
Okay, Comcast in focus, under some pressure today off the back of their latest numbers. They saw loss of some subscribers. So they're certainly continuing to face some headwinds there. Mixed bag in terms of their results. They did be on the bottom line, $1.09 a share on an adjusted basis. Street was looking for 98 cents a share. Revenue, $28.89 billion. That's shy of estimates. Again, so you had an earnings beat, but revenue slips for them. You have this exodus of broadband customers, the continual cutting of the core. The biggest drag, 199,000 broadband subscribers lost. That's worse than what was expected. The expectation was for some more cutting of the cord, but not at that level. There's some worries about, obviously, the impact of these economic headwinds, the tariffs. That's just the kind of continued conversation that we'll have there. Where that is visible in terms of a slowdown, theme park revenue, that's down 5% because of lower attendance, and also the LA wildfires had an impact, disrupting operations there. But also one thing that should be noticed, advertising. You saw media ad revenue drop 6.8%. That's something we pay attention to when it comes to any type of economic softening, and if there's some weakness there, some pullback in ad spending. So there was a decline there for Comcast. So there's something to pay attention to. We also saw some pressure on Charter Communications off the back of these results from Comcast. So again, you're seeing some pressure on Comcast this morning. That stock down more than 4.5%, coming off the lows. It was down sharper earlier in the session.
And I think of this name, and then I think of the others in the competition, right? Netflix, for example, which, I can't believe my eyes, but it looks like Netflix today is at a 52-week high. I don't think anybody would have expected that in this particular market. Netflix right now is at a 52-week high of 1,078. 1 year up almost 100%. Then you have Google coming up. We're going to hear from Google. They have YouTube, and the analysts are saying that Google normally beats. So we will see what they have to say. But the competition is tough.
It is. And look, Netflix is the king of streaming. And they gave indications that even though, like with guidance recently, it was strong guidance, they had a very strong quarter, but they also painted that picture in that Wall Street Journal article about what their 5-year plan is, planning to become a $1 trillion company. Obviously, they can't guide for that. That's not typical to guide that far out, but they're planning for that. Now, to be fair, Comcast did have some streaming growth in Peacock. Peacock added 7 million new paid subscribers, which was above expectations. But again, big picture there, the overall revenue slipping is indicating some weakness in the ad spend there, something to pay attention to, Nicole.
Yeah, well, that's big to add 7 million.
Yeah.
That's a big number. I think that's a big number. When they lost 630,000 for the subscribers for Comcast in general. That's sort of...
It is, but Netflix is still king.
Netflix is king, no doubt. And they don't face the tariffs. And when people want to save money, maybe they don't go on a trip, maybe they don't go out to dinner, maybe they stay home and watch Netflix. That could bode well for that name as well. Diane King Hall, nice to see you always. Thank you.